So today, as I said, in just a couple minutes, we're going to go through lecture 2, but there's a couple of other administrative announcements that are coming up. So we have 3 guest speakers that are now sort of formalized. So on Wednesday, as in September 16th, Stas Casa from Bloomberg will be our guest teacher, lecturer, the whole day. He'll be here for all 4 sections. And he's going to do some more advanced training on using the Bloomberg terminal. So basically what he's going to focus on is, in addition to being our Maryland rep, he used to develop a lot of the equity screens that you use when he's at Bloomberg, still is. And so he's going to teach you how to do sort of more of the advanced equity stuff that we're going to do in this class, like how to do the RV screening, the FAs, the economic analysis, etc. He's also going to teach you, which is going to be very important for your next homework assignment, how to create custom fields. So Bloomberg will allow you to create custom fields. You will need to do that for your next homework assignment. Stas is going to cover that as well. And I asked him to do it with some working real-world examples. On Monday, we're going to have a second guest speaker from Bloomberg named Erica. Erica is in charge of the education practice at Bloomberg. Again, she's going to show you how to do the industry analysis at Bloomberg, sort of the BI stuff. She's also going to show you how to do equity screening on a more advanced basis than what we did for our simple homework assignment. And she's going to show you how to use the portfolio tools, which will really help you with stock track. Okay? So that's what Monday's class is going to be about. And then on Wednesday, September 30th, the VP of Investor Relations from Lockheed Martin is going to teach just the 1230 section of this class. All right, so I mentioned we're going to have some executive sponsors. He's going to be the executive sponsor for the 1230 section. He's going to talk about how he works with the analysts, and as a former analyst, what he does for a living, and do it more as a teaching type of a class. So I'm going to have it recorded, but if enough people from the other sections want to, kind of sit through, then I'll try and get a bigger room. But otherwise, he's going to actually teach it here in this Bloomberg lab. So that's their guest speaker. Obviously, you'll have a different guest speaker later in the semester, but that's the first of our corporate sponsors that's going to show up. So it'll be Wednesday, September 30th. It really doesn't apply to you in the 2 p.m. section, but that's for the 12:30 section. So that's what's coming up. All right, today is group day. So if you're not in a group, you need to be in a group. So again, if I look here under project groups, I got 17 unassigned students. Right now, I believe you are section 301?
Or 201.
This is confusing to me. All right, so you're section 201. Because the last section was actually 401, which comes before this section, but whatever. So you're section 201. So obviously we have some teams with 2 people. We have some teams with 7 people. So we need to have a minimum of 5. So let me just ask by show of hands, who is not in a section? There's not a team. So 1, 2, 3, 4, 5, 6 people. All right. So what we're going to need to do is basically take these 2 teams of 2 and put 3 people in each of those 2 teams to get them to be at least teams of 5. Okay. So you have 2 choices. One, you can kind of drag yourself into one of those teams of 2, right? And so get to teams of 5. Or see me at the end of class if you have any trouble adding yourself, and then I'll add you to one of those teams at the end of the class. Right? So the reason I mention that is that today stock track starts. So 1 member from each team, if you haven't done so already, needs to go to the syllabus. There's a link on the syllabus, which you need to copy and paste into a browser to sign up if you haven't done already for stock track. You must sign up with that link to be associated with this class. You'll pay the $31, credit or debit card, get the rest of your team members to reimburse you an equal share. And then once you create the account, you'll basically choose a team name. Now make sure it's something that is, universally acceptable to be displayed. So you can be creative, but be careful on how creative you are. Use your team name, get your individual login, which would be an email address, or I think it's a username, and password. And then that'll be your team's login to stock track. Once you create the account, you'll get $1 million hypothetical dollars, and trading starts today. So between now and October, which will be the first grading of this, you need to make 10 trades, right? You don't have to make, you can make more than that if you want, But basically, the competition starts today. And then the first scoring will be in approximately 45 days, all right, on your relative performance compared to your teams. Now, stock track, as I mentioned, I've disabled a few things. So one thing that I disabled is everything but equity. So you can buy stocks, you can short stocks, and you can buy and sell ETFs and mutual funds. That's it. Everything else has been disabled. I've also set a minimum price of $3, right? So there's no trading penny stocks. So you can buy or short something that has at least $3. Now, if it goes below $3 and you buy it, you can sell it. But you can't buy something with less than a $3 stock price or short something with less than a $3 stock price. And I disabled day trading, which means if you buy something or short something today, you can't sell it or cover it until at least tomorrow or the next business day. Okay. Again, features available within stock track, but things that I have disabled. Okay. Otherwise, should be relatively straightforward. And again, your teams are going to be responsible for self-managing your accounts. Questions about stock track? All right. Once you have chosen your name and registered your group, I will then ask that one person come in and for your section, instead of having 201-1, overwrite it with the name of your stock track group. So that way you know who your peers are that you're competing with. Because the stock track performance is going to be based on the 7 teams within this section as opposed to the 28 teams across all sections. Right? So the stock track performance is within the section that you're registered for. That's what you're competing in the relative performance that matters. Yes?
Can people see what you bought?
No. So I, as the instructor, could go in and see what you bought, and your team members can see what you bought, but the other teams will only be able to see your portfolio value. They won't, and they'll see, I think, the number of trades you made, but they won't actually see what you own, unless you tell them. That's up to you. Right? Good question. Other questions? All right, and then let's briefly talk about homework 1 and homework 2. So you should have completed both of those by now. I'll post later today the solution. But if I go here to homework 1, then you should have a solution file that looks something like this. Obviously, it could be slightly different depending on the day of the week, which could change the multiple slightly in the long-term growth rate. But I told the TAs to accept that as a range. But basically, it should look something like this. All right, so for Coke, Pepsi, and Monster, should have gotten growths in that range and the PEs that match. Questions about mechanically this file? All right, so the point here is really 2 things. One, when you look at multiples, and we're going to get deeper into multiples later this semester, what I want you to understand is the multiple is really an expression of expected growth, expected return, and expected risk, right? So it's not really just a number, it's what's behind the number that explains the multiples. And this is more an advanced understanding of multiples. And so this should actually start to tell you something as you look at these 3 companies. So as we look at this analysis, what might you have learned by seeing the data for growth, return, and risk, cost of equity? What insight might we have gotten right off the bat just from this data for Coke, Monster, and Pepsi? They kind of jump out at you? Yeah. Oh, yes. Yeah, absolutely. Monster's still a younger company. They're still in growth mode, and there's a lot more expectation for growth than a Coke or a Pepsi. What else might be different about Monster than Coke or Pepsi? Yeah. Yeah. And you might even expect that because they're an earlier stage company. And that's very important because one of the things when you do multiple analysis is finding the correct peer group. And we'll put these 3 companies together, but they're a little less comparable than we think because Monster really has a different level of risk profile than the other 2 peers, and Monster's at a different stage of growth than the peers. So you can't just take the average multiple of 38, 18, and 19, average them together and say everybody's going to eventually get to that multiple, because that's unrealistic for Coke or Pepsi, because as mature companies, they're probably not going to get Monster's level of growth. And the flip side is Monster's probably not going to stay at a PE of 38 going forward, because what's going to happen to Monster? I have 38 here? I have 38 here. Anyways. Oh, I know. Somebody was asking me about their homework assignment. 8.01. They put it in 8.3 and they wondered why the TAs didn't give them credit. So I said, that's why, because your PE would be 38, not 33. Anyways, so back to this. Basically, 8% growth, and Monster's not going to maintain a PE of 33 because eventually they're going to look more like Coke and Pepsi, and their multiple, when they start looking like Coke and Pepsi, is going to come down, right? And so that's what we have to understand about multiples, not just average them out, and that's what everybody's going to trade at. That's just a very naive approach to multiples. Now, I'm not saying we don't start kind of simplistically for that. And understanding an average of Coke and Pepsi makes more sense because they truly are peers, but Monster's really at a different stage. This is what makes multiples much harder than people think, because it seems like a very simple way of doing things. But these are the nuances we're going to get to when we get into multiple analysis. Right? So regardless, this is what you would have had to do for your first homework assignment. Homework 2. Erica from Bloomberg on next Monday is going to teach you how to do more advanced equity screening, particularly using some of the custom fields. But basically, on a very simple one that you should have done, you should have gotten a year-to-date number that included, what's the answer on here? How many companies are on this list?
140 something.
Yeah, I'm sure. Oh, there. Approximately 146 companies. Now, again, I don't know, depending on the day of the week, it might have been plus or minus 1 or 2, but it should be somewhere in that number. If you came up with like 300 companies, that's obviously a wrong answer. But hopefully, just 146 sound about right for most of you? 140? 143. That's what I said. Depending on price changes, it could have been somewhere around that number, right? But that would have been a very simple equity screen. Now, what's more important, and this really was to set you up for stock track, because you needed to then kind of make your case for why you'd buy one of these companies. And so for your stock track teams, if you got 6 or 7 people, you got 6 or 7 initial companies to think about for stock track as opportunities. And that's the way you should start thinking about some opportunities for stock track, is using some of the equity screening tool to help you do that, right? So I won't say that there's a right answer for how, besides this one, how to do the screen. You got to do the right screen. But how you evaluate, the important thing this semester when the TAs are grading you, and when I'm going to grade you and be a judge, is you have to use the frameworks that are in this class. So if you use like Investopedia to justify things, you're just going to get zeros on assignments, right? Investopedia, your historical finance books don't apply, because if we say using the principles in this class, you need to be talking about things like key value drivers, you need to be talking about ROIC, you need to be talking about growth rate, and those are the things that have to apply when you're writing your assignment. So you had 8 chapters worth of reading. If you're not using any of that for this assignment, I'm going to tell the TAs to give you zeros on the assignment. All right, so you have to use what we teach in this class when you answer your assignments. The other thing that's going to be very important is you have to use numbers. Because if you don't use numbers in your answers, we don't know what you're referring to. Because I could just say, Monster's growing faster than its peers. Well, that's such a general statement that I don't even know if you know what you're talking about. Because are you talking about revenue growth? Are you talking about G as we're defining in this class? And what does faster really mean? So that's why it's very important to refer to specific numbers so that we know that you're actually talking about the right thing and that you understand the concept. And that's just going to be true in all of your assignments this semester. So just giving blanket statements will cause you to lose points, because blanket statements in a finance class are meaningless, right? So you have to show us what numbers you're referring to when you make the statement, so we understand that you understand the actual concept. So that's just going to be important as you do these assignments. All right, so again, this one was pretty open-ended, pretty relatively easy. So let's talk about lecture 2. PowerPoint. All right, EIC. EIC stands for economy, E is economy, I industry, C company. And the key to EIC is approximately half, plus or minus, of a company's performance is based on the industry that it's in. right? And I think I made this reference last time we were together, is, think about oil companies. Doesn't matter who you are, if the price of oil is at a certain rate, this is what you're going to suffer with, right? And I'll give you an example of this. So last Monday I was working with Access Bank from Nigeria. Now fortunately it was Labor Day, and they came to Philadelphia. They were at Wharton, so I didn't have to go to Nigeria before I went to China. But basically, I was with them in Philadelphia. And their PE, their price to earnings multiple, is 2.6. You can buy the entire bank for about 3 times next year's earnings. And for a non-insolvent company, that's one of the lowest PEs I've ever seen, right? And that's what they were curious about. Like, why are we trading at 2.6 times earnings? Because their return on equity is like 15%. I think it was a proxy for ROIC, and they're growing at almost 20% a year. So they have great growth, they have great returns, and the bank is trading at less than 3 times earnings. So how does this make sense? Well, I did some digging, and what I found is that they're based in Lagos, and Nigeria is pretty dependent on oil. And the last time oil was in the 40s, back in 2009, 2010, non-performing loans for Nigerian banks went to 40%. And 10% of those loans were completely written off, right, as non-collectible. So that's the point. They're a bank lending to people who either are oil companies, sell to oil companies, or work for oil companies. And so what the market is doing is the market is expecting that because of the economy, global economy, and oil to be where it is, that they're already predicting some problems that yet haven't happened to this bank. So here's the thing. If this bank has actually, and this gets back to StockTrack, this is a mispriced bank because the analyst estimates for this bank suggest that their multiple should be like 8 or 10. Or if you run it through our formula, you're at 8 or 10. Their multiple's 3. So the market's going to eventually have to adjust this because the analysts have not changed their forecast for this bank. Because to be honest with you, the analysts probably don't know what to forecast because they don't really have any idea about how bad these non-performing assets can get. They have some historical data, and so the institutions are pricing if it's going to get bad, but the analysts have not actually changed their projections. Over the next few months, this is an example of a stock price opportunity of a mispriced stock where you could potentially make money in one direction. It's very risky, but you got to figure out who's right. Is the market right that they're going to have a lot of bad debt? Or are the analysts saying maybe it's not going to be as bad as the market thinks it was the last time oil prices crashed, and this is a good buy for the stock? Because there's a lot of buys from the analysts on this company. So again, I'm not saying I'd use real dollars because there's a lot of risk in this and some currency risk as well, but StockTrack could be interesting to think about it this way. So I go back to this, and I want to go back to EIC, and what I want to say is the impact of the economy on the banking sector is going to be very important. The impact of what happens in Nigeria to a Nigerian bank is going to be very important. So whether it's Access Bank or Ned Bank based out of South Africa, if Africa struggles, all of these banks are going to struggle. And so that's part of the way we need to start thinking about companies and industries, is what is the economic impact on the industry and the company, and what is happening at the industry level that's going to affect the industry or the company. So we talked about Warren Buffett and his view of the world. That's part of the view of the world that I want you to start thinking about, is start with the industry impacts, then go to C, which is company, and then think about the company impacts, right? So we're going to give you some tools on how to do that. So again, on next Monday, when Bloomberg is here, they're going to talk to you about industry tools. On Wednesday, when Stas is here, he's going to talk to you about the economic tools, right? So I'm not going to spend a lot of time today talking about how to get forecasted economic data out of Bloomberg, because you're going to get that coming up, but that's the first point. What's going to happen to the economy? Question number 2, and this is anywhere in the world. You get your good data from Bloomberg. Question number 2, okay, what about my company? Well, here's what we're going to do as a proxy. What we're going to do is we're going to use beta as a proxy for economic sensitivity as a company to an industry. So let me explain. My apologies for people on the video, but Microsoft Windows 10 keeps going to sleep on me. I have no way of figuring out how to stop it. So hopefully I'm logging back into Bloomberg. we go. All right. Who are we talking about? Oh, yeah, McDonald's. ECSU, it's called the Economic Surprise Index. And I think I mentioned this in our first class, but I'll bring this up again. What this screen basically shows you for 5 years is whether or not we had positive or negative economic news against expectation and change in the S&P 500. And it's not a one-to-one correlation, but over the last 5 years, it's been pretty strong correlation that basically says that economic information, good or bad economies, are leading to what happens to general stocks and bonds, trades in stocks particularly. So that's the idea, is that think about what's happening in the world today. You know, right now, there's a lot of anxiety about what's going to happen to the U.S. economy. So investors are either buying all stocks or selling all stocks. Yeah, some individual stocks are getting hurt more or less, but economic activity is driving a lot of trading, right? So there's a view that economic activity will affect financial performance. So what Bloomberg is just showing here is the correlation over the last 5 years, not one-to-one, but pretty close, that says there's a proxy that says the performance of the S&P 500 is going to be tied to economic activity. So here's the next correlation. What about an individual company like McDonald's? How do I tie its correlation? What we're going to use is beta as the proxy, because beta says how do I perform volatility against the market. So therefore, through transitive property, how am I influenced by the economy, right? So here's the idea. If I have a beta of 1, then typically market goes up 1%, market goes down 1%, I go up 1%, down 1%. I'm kind of moving with the market, which means I have the general economic sensitivity of the market. If my beta is well below 1, then I am less sensitive to the market. And if my beta is well above 1, I'm probably going to be more sensitive to the market. And so think about a valuation class. We're eventually going to be forecasting cash flows. So I don't want to just have a straight line for a company with a high beta. That doesn't make any sense because they're going to have cyclicality, and I need to forecast cyclicality into my business. Or a very low beta, yeah, that's going to look a little bit more like a straight line. So let's think about McDonald's. Is McDonald's a risky company? Well, what we're looking at is their raw beta. Their raw beta is 0.64. What do you think? High risk, low risk? And by the way, 0.64 is their industry. Sorry, McDonald's is 0.44. Look at the wrong data there.
Low. Very low.
Much lower. So first of all, and this is what they teach you in portfolio theory, if you're looking for a safety stock, McDonald's is much closer to being a safety stock because it's a much lower beta stock, right? But that's the other thing. McDonald's, and here's the other key point of this slide, is what I really want is, you know, McDonald's and Burger King and Yum and Jack in the Box and Sonic and Wendy's, there's probably not too much difference in these fast casual firms in terms of risk. So I also kind of want to have a sense of what's the industry beta for fast casual, fast retail food, as opposed to just McDonald's in and of itself. So I kind of want to have the idea of an industry beta. So here's how I do this in Bloomberg. If I haven't done it already, and again, Stas will show you how to do this on Wednesday, when you go to the RV section, you can go here to settings, you go to global settings, and one of the settings is you can check this box for statistics, and I check market cap weighted average, so that anytime I bring up a screen in Bloomberg for comparison against peers, it always calculates the market cap weighted average, right? And the reason I'm using market cap weighted average versus just a straight average is I don't want to have a tiny company like a Popeyes distorting my average against big companies like a McDonald's and a Starbucks, right? So I want to weight it based on market size. Now that could be a problem because if I then use Walmart as my company, then Walmart is so big that other retailers almost become irrelevant to the retail industry. But regardless, we're going to use the market cap weighted average, right? So at least it'll weight based on size, the numbers. But that's just a default field in Bloomberg. So therefore, when I get a peers, this gives me a peer average. Then I come here to markets, and then I come here to beta, and that's the screen I took the screenshot of. So Bloomberg will take the peer group and give you a market cap weighted average for the peers. So that's the raw beta of 0.64. All right. Now Bloomberg also gives something called an adjusted beta. An adjusted beta includes what's called a regression coefficient. And the way they do the adjusted beta is they take 2/3 of the raw and 1/3 of 1, and they do an average. So they're just basically taking the raw beta and moving it 33% closer to the mean. right? So this is just a statistical argument that statisticians believe in regression to the mean, so they throw in these regression coefficients. For purposes of this class, we have to choose raw or adjusted, and I don't really want to get into an academic argument about it because we'll never agree to it because academics don't even agree, but we're going to use the raw for purposes of this class. And here's why. If I go to the beta for McDonald's, just by typing beta, this is how Bloomberg's calculating it. Here's the percent change on a weekly basis of McDonald's, percent change of the S&P. This is the data point. This is the scatter diagram. This is the best fit trends line. This is the slope of the line, which is the raw beta. So here's the idea, which is I want to look at economic sensitivity, so I care about the actual line. All right, that's why we're going to use the raw. All right, because I'm just trying to answer over time, how does McDonald's move against the S&P 500? Well, that's what the raw beta actually told me has been happening. So for purposes of economic sensitivity, we're going to use the raw in this class. Questions about that? All right, let's do another industry. Give me another industry, and let's look at its economic sensitivity, or another company that we can do an industry around. Okay, who would be an example? I'm sorry?
Tesla.
So let's look at Tesla. All right, and let's look at peers. It doesn't have a lot of U.S. peers. So let's look at, I'll just look at the U.S. peers for now. Say we look at global peers, but for purposes of this, let's look at the U.S. peers, and we'll go to, oh, wrong one, markets, beta, industry above 1, Tesla 1.15. All right, it would make sense that Tesla and the auto manufacturers are much more sensitive than fast casual foods like McDonald's and Chipotle, right? And that's what we see in the trading. So this is what I mean by different levels of industry performance will affect these companies. And if I'm an auto manufacturer, then I'm probably going to have to think about economic sensitivity differently than a fast casual retail company. Questions? That's the E. Here's the I. And the C, for that matter. I want you to start thinking about an attractive industry very specifically. The definition that we're going to use for industry attractiveness is industry spread. Specifically, the ROIC that we can achieve in an industry against its cost of capital or against its WACC. So an attractive industry over time will have what we'll call a positive spread difference between ROIC and WACC. So that's how we're going to define an attractive industry. Right? Now, does it mean it has to have a positive ROIC WACC spread every year? No. You know, think about an auto industry. Could have a great return over time, but maybe it's in a bad year because it's a cyclical industry. Just because it has one bad year doesn't make it a bad industry. So over a cycle, over time, is it a positive spread? That's what we're going to be really concerned about. So industry spread is industry attractiveness. Now, I'm going to jump a few slides because I want to then define competitive advantage. Competitive advantage is going to be defined as relative spread to your peers. Right? So here's the thing. So I've been telling the previous classes, over time I've probably worked with over 100 companies. I actually worked with 4 different banks last week. It was a very busy week. So here's the thing. I've never been to a company, no matter how poorly they're performing, that doesn't believe that they don't have competitive advantage. Everybody thinks they're good, right? The reality is, and this is harsh, is that there's about 40 people in the room here today, and you're all probably really good students, but by definition, half of you are below average, right? Now, I don't want to get into a, I'm one of the below average, terrible students. That's not the way, because we could be an above average cohort, but that's the problem. Even if we're in a good cohort, we can't all be valedictorians, right? And so that's the point, is that if I'm an investor, I want to go find who the valedictorians are, and that's who I want to bet on as investors. So relative performance matters. So competitive advantage is really not am I doing well, but how am I doing against my peers, right? So competitive advantage is outperforming peers. So I'm going to use a financial definition because this is a financial class, which says I need to demonstrate better spread than my peers, better ROIC, cost of capital spread than my peers over time. That's competitive advantage. And what I want you to start thinking about is some companies make money not because they're better than other companies, but just because they're in good industries, right? So I can just make money because I'm in social networking, and social networking is a hot growth market, right? As opposed to I can't make money because I'm in oil. That doesn't mean I'm not a good oil company. Some are going to do better than others. I could have competitive advantage in an industry that currently is destroying value. I'll just relatively destroy less value because I'm better at it than you are. But there's nothing I can do because I'm in a bad industry. So competitive advantage is relative performance, right? Where the industry is the overall performance. Now, assuming that the cost of capitals are similar, ROIC is the most important driver, but ultimately it's about spread. And when Stas shows you how to create custom fields, you'll create a custom field called spread. So you can quickly see this within Bloomberg, right? And that's what I kind of did for McDonald's. So if I go back to McDonald's, here's data from McDonald's, right? So basically, here's what will happen. You'll type in McDonald's, US equity. You'll go to RV. You'll go to custom. You'll type in ROIC for the latest year. You'll type in WACC. And we're going to use something called operating ROIC, which is, again, a custom field. So we care more about operating ROIC than what Bloomberg calls ROIC. Right? This is something I've actually told Bloomberg for 3 straight years they should add as a default field in their terminal, but they don't. Right? Because I find a flaw in the actual definition of ROIC. Right? So we're going to care about the spread between op ROIC and WACC. It's not going to make too much of a difference in answering this question, but operating ROIC matters more to us. All right, so look at op ROIC, look at WACC. Is this an attractive industry that McDonald's is in? It's fast food, fast casual, however you want to call it. Is this an attractive industry? Yes or no? Does it look like an attractive industry? Yes, because I can make a 33% average return on invested capital, look at the market cap weighted average, against a WACC of 7.37% market cap weighted average. Does everybody see that? Question number 2. Does McDonald's have competitive advantage? Yes or no? Does McDonald's have competitive advantage?
No, because their spread is below the average.
Great, that's right. So I'm going to say this again just because we're recording this in video. He said no because their spread is below average. So question number 3, and I'll ask you directly. Is McDonald's creating value?
Yes.
Why are they creating value?
Part of it.
I'm sorry?
Just at a subpar of compared to the average.
Yeah, McDonald's has an 18.86% operating ROIC against a 6% cost of capital. Think of 18.86 like IRR. They're positive NPV. They're creating value, right? But they're not creating as much value as the average company in this list, so therefore they don't have competitive advantage. I would say that McDonald's is doing well because the fast food retail business is doing well, not because they're doing anything outstanding compared to their peers. Right? It's a different way of thinking about the business, but that's the way that I want you to start your assessment and evaluation. I want you to understand that there's a level of industry performance and there's a level of individual performance. Right? And sometimes we do well just because we're in a good industry. Sometimes we do well because we're better than our peers. Ideal investments do both. Who has competitive advantage in this industry, given that assumption? And there could be more than one company. So who on this list actually has competitive advantage? What companies?
Popeyes.
All right, to some degree, Popeyes. Who else has competitive advantage? Chipotle, Starbucks,
Domino's.
Domino's in a big way, right? Who's really performing poorly in this industry? Well, the big one that sticks out is Wendy's. Wendy's is the worst of the performers in this industry, right? So, as I said, that's the way I want you to start looking at this business. Does that make sense? Okay. So then you might say, what's the difference between operating ROIC and regular ROIC? Just kind of do a little diversion here to make sure you understand this. This, by the way, is going to be in the next, after the Bloomberg people come through and we do those assignments, we get into converting financial statements. We're going to convert financial statements to look at operating ROIC. Think of operating ROIC this way. What we do is traditional ROIC is the return on the debt and equity. Well, since the balance sheet has to balance, it's all the assets. Okay? So Apple, this weekend, released the iPhone 6S. Right? 6S, 6S Plus. This morning, they made an announcement that said since Saturday they had over 10 million pre-orders, right? Which is pretty impressive, right? So here's the thing. The return on invested capital for Apple using Bloomberg last year, 2014, is 24%, right? So what we're going to find is return on invested capital is a proxy for how much cash flow you generate. So I'm an analyst, and I hear they sell 10 million phones. They make 24% of their business. They'll probably make 24% of their phones. I will completely misprice Apple because this is the return on the debt and equity of Apple, which equals, because of balance sheet has to balance, all the assets, right? Well, what assets does Apple have? Well, right now, if I look at their balance sheet, Apple has a lot of cash, right? They have $25 billion worth of cash, and then they have another, I look down here at long-term assets, another $163 billion sitting outside the U.S. So they have somewhere close to 200, or whatever it is. How much cash they have? 100 and something billion? 187 billion added up together. That's the cash. So here's what I'm doing. I'm doing a return on investment, which includes a return on $180 billion worth of cash. Does that make any sense? Does that tell me what the actual return on an iPhone is? No, because they don't need to borrow another $180 billion worth of cash to sell another $200 billion worth of iPhones. That doesn't make any sense, yet that's the way that ROIC is actually defined. So here's what we're going to learn how to do. We're going to exclude what we're going to call non-operating items. Cash sitting outside the U.S. is a non-operating item, and let's just look at what's actually tied up in making iPhones. That's called operating ROIC. Right? So on Wednesday, Stas is going to teach you how to do custom fields. I'm going to give you a formula for operating ROIC. You're going to put operating ROIC into your terminal, and you'll be able to calculate ROIC operating by your homework assignment next Monday. And it's one of the things you're going to have to do. So you'll be able to calculate spread by next Monday. You'll be able to calculate operating ROIC. You'll be able to learn how to put this stuff in. And the next couple of weeks when you do your homework and do your reading, we'll teach you what operating ROIC really means. But I'll give you a quick example. If I go back to Apple and I look at their operating ROIC in a saved template, it's 255%. So I guess what I'm telling you is that they sell 10 million iPhones and they're making a 255% return on every one of those iPhones, they're going to generate a gigantic amount of cash. I'm going to have to make up the word to describe how much cash they have to do it, because gigantic is not even a word, right? That's the point. I'm going to misprice Apple if I use the actual Bloomberg definition. That's why Bloomberg's customizable, but I think this is a much more representative number that Bloomberg should actually use. So here's the point. What we're going to do is we're going to value the operating stuff. We're going to value the non-operating stuff. So I'm not going to ignore the cash. We're just going to value it separately. We're going to add them together. But they earn at different rates. What you're seeing is an average of the two. But the average of the cash return can mislead you. Right? You see a real example of this? So I was doing some work at Molson Coors, TAP, U.S. Equity, 2 years ago. So 2 years ago, February, I got to go to Fort Lauderdale, Florida. I was a guest speaker at the top 150 beer conference, 150 liters of Molson Coors. Did I tell you this story 2 weeks ago? So basically, it was the start of spring break, and it was just like a spring break party, except it's a bunch of 50-year-olds instead of a bunch of drunk teenagers. So, I mean, seriously, it was like rock bands and music and beer everywhere. It was a party. And I was there to rain on their parade because I was invited because the CEO knew that they are the worst performing beer company in the world in the golden age of alcohol, right? So they have Bloomberg. It's right here in black and white. Go to RV. Here's Bloomberg's beverage peers. So it's not just beer. It's, people like Coke and Pepsi, etc. So here's all the companies, and I come here to custom, and using Bloomberg, I type in ROIC based on the latest year. This is 2014. At the time, it was 2013 data, which looked even worse. And whack. And I can see, is beverages an attractive industry? Yes or no? Are beverages an attractive industry? Why are beverages not an attractive industry?
Because the return on invested capital is just marginally higher than cost of capital.
13 versus 7? You think that's marginally higher?
Yes, like the other example was 3 times higher. This one's half.
Okay. So here's the thing. It's actually really hard to earn more than your cost of capital, which is one of the things the book talked about this week. So this is actually still a pretty attractive industry, right? So that's the point about fast food is an amazing industry right now. It's far more profitable than people realize, right? Where this industry is actually still pretty good. It's just less good than fast food, but it's still really, really good. So it's actually a very attractive, it's still a pretty attractive industry. Yeah.
Is it always attractive? ROICs over WACC, or is there like a certain threshold for ROIC? It has to be above WACC at a certain point.
Well, so again, I'll go back to our reading for this week, and this was some of the data in the book. But over time, you see two things. Some industries are actually better than others. And over time, the average industry ROIC works out to be somewhere around 10 to 12%. Okay? So, and cost of capitals are probably somewhere in that range. So the average industry is probably not going to be in the 30s. That really is the exception. But even when you look at a good performing industry like, for example, tech, there's some years when tech has very poor performance, and some years when it has really good performance. So just because you're good doesn't mean you're good constantly at the same amount of time. So we do have to think about over time. But if we look at a snapshot, beverages are actually, relative to their cost of capital, doing pretty good. Because what the data also says is the spread at most industries tend to head towards your cost of capital over time. So if you can consistently out-earn your cost of capital, then you're actually doing pretty well. So for example, in the last class, somebody asked about a company called Exelon, and I accidentally put in energy, because I said Exelon's an energy company. I thought they were talking about NRG, the utility. So I'll go back to Bloomberg here. I'll just try this as a second screen. So I put in NRG just so you see the same thing. So here's energy, and here is peers, and I had added Exelon as a peer, so save that. And here is the spread as we just defined it. And so here's the point. These utilities, operating ROIC, 5.8%, cost of capital, 4.8%. Energy and Exelon, both below their cost of capital. There's an example of a business that's not doing really well. There's an example of an industry with no spread, right? So again, it's kind of industry dependent. So back to attractiveness, beverages are an attractive industry. Back to my point about Molson Coors. Does Molson Coors have competitive advantage? Yes or no? No. So again, Stas will show you that one of the screens in Bloomberg is you can do a 5-year total return to shareholders. They're the only beverage company on this list with the 5-year total return to shareholders was negative going through the end of 2013. You basically lost money investing in Molson Coors for 5 years, which is why I was brought down. So I was basically brought down to rain on the party in Florida at the beach with all the music and the alcohol and say, basically, you're the worst performing beverage company in the world. You guys suck. Your shareholders and the two biggest shareholders are sitting in the room. Our families are losing money. Fix your business. That was the message I was brought to deliver. This is the actual message. I only had about 40 minutes. Actual message I delivered on stage. Hey guys, you guys are doing amazingly well. Keep up the good work. Accelerate the growth. That was my actual message. And I was dead serious. And I had data to back it up. Because what I did is I looked at their operating ROIC. And the operating ROIC of Molson Coors is 18%. It's not 5%. And for the people in the room that make beer, that's the rate of return they're actually making on the beer business. So why do I want to tell them that they're screwing that up? Why do I want to tell them that they should slow that down? Because if they keep making 18%, stock price is going to go up. That's a very good performance for a business. Now, is it as good as the rest of the industry is making 30? No, but it's not a bad business by any means. This is how Bloomberg itself, in the way calculations are done, can be a little misleading. And here's why. What ROIC includes is non-operating performance. So what is non-operating performance? One, it's cash. Two, it's joint ventures. So here's the other thing. Molson Coors has a big joint venture with SAB Miller. They don't run it, but they've dumped hundreds of millions of dollars into it. And nobody in that room that I was talking to was part of that joint venture. And that's the big black hole of terrible performance at Molson Coors. So the problem is not their beer business. Their beer business is actually doing pretty well. The problem with Molson Coors is the joint venture. So that's what I said. The problem is if I had gone in as a naive analyst, I would have told them to basically kill the part of the business that's performing well, right? Because basically it looks like when I average the whole business together, the beer business is performing poorly. When the reality is, fix the joint venture. Stop investing in this joint venture that's not making money. Just keep selling beer, and you're actually going to do pretty well over time, right? This is why we rearrange statements in a few weeks, because we will be able to get these insights. And this is why McKinsey, by the way, makes the big bucks. Because people like JP Morgan Chase come in there, and they use the standard Bloomberg template, and McKinsey comes there with my story, and that gives you far more insight as to how you're performing than the traditional banker. Right? And I'm just telling you, this will give you a much better understanding of what's going on over the next 3 months. So these are some of the fields that we're going to rearrange. Questions about any of this? All right. So let's go back to this. So what we need to do, yes, sir?
So why are analysts now still using ROIC instead of operating? Why would they still continue?
Because that was what they were trained in business school. There's only 2 business schools in the country that train people on how to do operating ROIC. You happen to be at one of them.
Think that's gonna change or no?
I hope so. But I'm telling you that, I mean, just be practical. What did you learn? You learned out of textbooks that were written, I don't know, I had Brealey and Myers as a Wharton student back in the 1980s. And Brealey and Myers on its 7th edition, but every year all they do is change a couple things. But nothing's changed in these textbooks in 20 years. And basically, theoretically, nothing needs to change because theoretically it's the same stuff. But in the real world, they're just nuances that the academics don't have to worry about. And that's what I'm giving you, is I'm giving you the real world nuances. You notice that we don't have a traditional textbook in this class because I'm assuming you know the theory, and then it's how's the theory actually used. And as I said, that's what people like McKinsey do, is they actually take the theory and they go to the next level and they try and make it extremely practical and very real world. And they're not perfect. I'm not saying that they're perfect in any way. No one is. But they're more practical in the way that they apply it. And that's the challenge that I think a lot of the academics have is that, first of all, in 4 years as undergrads, we can't teach you the real world. I mean, that's why you had to do all of that stuff just to come to this class. Right? And then you don't usually get to the real world until you actually show up in the real world. right? And by the way, think about most business leaders that work at the top companies. They didn't get the training that you got even over the last 3 years. And then they got to try and understand this stuff. So we simplify, right? So ROIC is a simplification. And directionally, it's correct. And directionally over time, it works. But every now and then, there's some nuances which people don't understand the subtleties. And so I'm teaching you the subtleties. So it doesn't mean you'll go to another class that teaches a different way and say that they're not doing it wrong. What you'll understand is how they're doing it different. Or if somebody makes a shortcut, how they're taking a shortcut. And I gave that example last class about free cash flow. So for example, you're going to learn in this class how to calculate free cash flow correctly, which is the entire change in the operating assets of the balance sheet, which includes changes in working capital. Yet when the head of investor relations from Lockheed Martin shows up as a guest lecturer, Lockheed Martin calculates free cash flow as gross cash flow minus capital expenditures, and they ignore changes in working capital. Right? Does that mean that he's wrong? Right? I wouldn't say that to him, but it does mean that working capital changes are being ignored when they report free cash flow. And what they're really saying is, to us, working capital doesn't change too much over time, so therefore, we don't think it's as important to look at the changes in working capital as our change in CapEx. But if I'm really trying to value Lockheed Martin, I probably want to look at the changes in working capital too to get a realistic value, because again, I have to go to Merck, and when I met Merck has way more working capital than every other pharmaceutical company in the world. And right now, when they're not growing, dealing with all this extra inventory that's sitting around of pills that go bad is actually a big deal to them when you got billions and billions of dollars of pills sitting around that you can't sell anymore. So for them, it will affect their valuation, because if they can't cut their inventory, it's going to chew up a lot of less profits that they have to keep reinvesting that they then can't sell or have to sell at a discount. So that's what I'm saying is that you'll start to understand when people take shortcuts or when they do nuances, kind of that it is a shortcut or it is a nuance, but you're getting a more sophisticated view. And as I said, we're trying to explain the real world. It's not perfect, but you're having to deal with actually how the meat is made. Harvard Business School cases are not set up that way. Harvard Business School cases are set up to have a perfect solution to that perfect problem at a perfect point in time, which is great at Harvard, right? But when you work in Manhattan, that's not what you're going to get. And you're going to get a PE like Access Bank at 2.6. And you're going to have to try and explain a PE of 2.6 when the data doesn't support a PE of 2.6. And what the hell's going on? That's the world that, unfortunately, we have to live in. And that's what we're going to try and deal this semester, which, to be honest with you, makes this class kind of fun. Because we actually have to figure things out. You got to play your detective role and basically try and do the data. And the nice thing that you have is you actually have the tool that the same people in the real world are using on their desk to do the exact same work that run mutual funds with hundreds of billions of dollars in them. So you're getting the same data that they do using the same terminal and the same screens. So if your analysis is as good as theirs, no reason why you can't be a fund manager that does just as good as them, because you're actually going to practice this. All right, back to this. Couple things. One, ROICs regress to the mean over time. You got to remember that. No company is going to have a competitive advantage forever. It's just not going to happen. So back to Apple. Their operating ROIC last year is 255%. They're firing on all four cylinders. You go out 10 to 15 years, Apple will not be doing as well a decade from now as they are today. Nobody's done that forever. It just can't happen. That needs to be our view when we value companies. Because valuing the companies is forecasting the future cash flows. So when companies get really big, it's not do they have advantage. It's how long will that advantage last. And we got to be able to start to quantify that. So here's another thing, growth. This is another mistake people make with forecasting. Growth for big companies compresses faster than ROIC. And they included a new chart in this week's reading that I think is a great chart to explain this. And I put it on the slide. It is an overlay. And it's the law of large number effects. So what they did is they basically said, here's a company that grows the same amount of dollars year after year after year, and here's the percentage growth spread out over time. And this is a really good illustration of the problems with growth, is that when you get bigger, the percentages mean even more dollars. And so here's how it manifests itself. You have 5 years of historical growth rates for a company. 10%, 10%, 10%, 10%, 10%. So we want to forecast the next 5 years. 10%, 10%, 10%, 10%. It's not going to happen. And the reason it's not going to happen is because 10% compounded growth on bigger numbers gets harder to do. Apple will never grow 20% like Google's growing 20%, because when you're $200 billion in revenue, 20% is $40 billion, which is 2/3 of Google's entire sales. So unless Apple buys Google, they're not going to grow 20% in 1 year. The numbers are just too hard to get $40 billion of new revenue. And I say never, never. Apple's done some crazy stuff. Maybe they will. But it's extremely unlikely, right? And so that's the other thing. Google, which is growing at 18%, is probably not going to grow at 18% a year for the next 5 years, because when you're a $60 billion company, compound annual net growth. Every year gets harder as you get bigger. That's what this data tells us. And that's a common mistake people make when they forecast. Because what they'll assume is the growth rates in the past equal the growth rates in the future, and that's easy to do. But they get harder to do. That's why they call them comparables. All right, the comparables get harder because they're bigger numbers. Because 8% next year is different than 8% 2 years ago once we're a bigger company. All right? And by the way, that's what I was trying to explain when I was in Beijing to Ping An Bank. All right? Because the Chinese are all upset that their economy is not growing at the government mandated rate. And what I was trying to explain to them is the government mandated rate, if you stay at the same, is harder and harder to do every year, because the actual amount of economic growth in real currency has to get even bigger every year. And it's just law of large number effects. So that's the point. Like 7% on a bigger number is not as bad as 7.3% on a smaller number if you're a bigger number. And so we have to get out of that game, and we have to start thinking about what realistic growth rates are for companies, and recognize that 4 and 5 years out for bigger companies starts to get closer to 6%. That's what the data says over time. Can there be exceptions? Yes. But that's the data that you got out of this week's readings. Right? So you got some really good data for forecasting, which I'm going to make you apply to your next homework assignments. So again, I'm not going to cover what you've already read in the book, but basically it talks to you about how to think about ROIC, how to think about growth rates. If you have any questions about the textbook, please ask. But I'm just assuming you've done the reading and you understand everything in the reading, unless you otherwise ask. So it basically talks about this in the book. All right, so with that in mind, this is going to then be another key part of your next homework assignment, which is the forecast of the industry performance, the forecast of the industry ROIC, and the forecast of a company's ROIC. How do we do it? Because we got to predict the future. Because again, it's great to have a starting point for ROIC for McDonald's, but what's it going to look like in 5 years? What is the retail, fast food retail ROIC going to look like in 5 years? So let me ask you this. Here was the screenshot from this morning. Here's McDonald's. Here's their operating spread for McDonald's. Here's the operating spread for McDonald's peer group. Should our bias be that this number stays at 33% in 5 years, or should our bias be that it will be a different number in 5 years? What should our starting bias be? And why? Think of this as you wonder what kind of questions I'm going to ask you on part 2 of the midterm this year? These are the types of questions I'm going to ask you in the part 2 of the midterm. So think of this as an open-ended essay question. And your open-ended essay question is this. Should our bias be that the operating ROIC for this industry stays at 33% in the next 5 years? Why or why not? What would the answer be? Yeah.
I should be that it's going to decrease and regress to a lower number because of what you just said. If it's growing 30% pretty quickly, then you're not going to be able to. Then that growth is going to happen, and then you're going to slow that down so that they don't overextend.
Yeah. I'm just saying, I'm not saying that fast food can't stay at 33%, but that should not be our starting bias. Our starting bias should be, these are the best of times, these are the good old days, and it's going to get tougher from here on out for probably reasons. So we need to probably start that as a bias. Let me ask you this. would you answer the question the same way for this industry? Is the ROIC in this industry likely to be lower as a starting bias in 5 years?
No.
Why not?
It's sustainable for them if it kept getting lower and lower.
Yeah, and if you go back to the chart, companies that earn their cost of capital tend to stay at their cost of capital. And why would companies want to start going below their cost of capital? I'm not saying that they can't make some bad decisions, they can't have some views, but if I'm already at my cost of capital, I'm probably regressing to where I already am. Or if I'm way above, it's hard to sustain that. All right, so that's my point about Apple. Apple's just the peak of the peak of the peak. And staying at the peak of the peak of the peak forever, nobody's ever done that. So can they do it for a couple more years? Probably. Will they do it for 20 years? Probably not. So I would be naive to forecast. By the way, the people that are predicting Apple 1 trillion, that's how they predict Apple 1 trillion. Because what they do is they use the growth rates for Apple for the last few years. They say you get the same growth rates going forward. They're not paying attention to how much dollar amounts that actually turns out to be. And then they're looking at Apple's ROIC, and they're saying that will never regress to the mean. So if you maintain historical growth and you maintain current ROIC, sure, Apple makes $1 trillion of market cap, right? But I got some fake Chinese currency to bet against that. That's probably likely not going to happen, right? So that's what I'm saying. This is what our bias needs to be. But how do we then explore the bias and answer the question? So this is the approach we're going to take. First, we're going to use Michael Porter's 5 forces as a way of doing industry analysis. You guys have all done 5 forces in previous classes, so we're going to apply 5 forces here. And the idea of 5 forces is it should help us explain industry performance. And so this is the metaphor. So rather than directly predicting industry ROIC, what we're going to do is we're going to explain the forces that explain the ROIC today. Then we're going to predict the forces changing for 5 years. And then based on the forces changing or not changing, that will then infer what we think will happen to the ROIC. All right? So for example, if the ROIC is 33%, and we say nothing about the forces of the fast food industry are going to change in the next 5 years, okay, then maybe it will be 33%. Right? But if things start to evolve and the forces change, then that at least give us some direction to give us guidance on our number. So basically by using the 5 forces, it will help us approximate directionality and magnitude of the changes of the forces rather than just going directly and predicting a number. Right? So we're going to use this table and a very specific set of numbers to help us describe this. So I started doing this in the last class. So here are the 5 forces. Here are the 5 forces. And I'm going to want us to use buyer power, supplier power, barriers to entry and exit, substitutes, rivalry, and the overall. Okay? So the overall is an observation based on the current data. So for the fast food restaurant industry, using a 5-point scale where 3 equals no spread, right? So I would call the NRG/Exelon industry a 3. It's basically no spread. We just looked at that, right? 4 and 5, very positive spread. 1 and 2, negative spread. What would you define McDonald's industry on that scale of 1 to 5? Yeah, that's probably about as 5 as you get. So I'd call this a 5. Right? Make sense? All right. Then, using the 5 forces, I want you to explain the 5. So I want you to score each one of those a 5 so it explains the 5 on a 1 to 5 scale. And here's the way I want you to think about it. If that force helps the industry achieve a positive spread, score that force a 4 or 5. It's not whether the force is strong or weak. It's whether or not the force helps the industry spread. If the force hurts the industry spread, 1 or 2, And if it's kind of indifferent, 3. You earn your cost of capital with that force. So think of it this way. If the force were the only force that mattered in determining the industry profitability, you should score this a 5. Because that force and the actual industry profit should equal each other. Okay, so I got to match it to the actual observed performance of the industry today. Okay, so buyer power. Somebody give me an answer for buyer power. Do buyers have power? A lot of power in fast food? Do we have a lot of choice and power over who we buy?
Yeah.
So give me a score for that one. 1 to 5. 5 basically says we have no power and they make a lot of money. Sorry, I just want to be clear. So if we say 5, that means we're not exercising the power and they're being very, very profitable because of that. So 2, buyers have a lot of power. 2. Suppliers. Do suppliers have a lot of power over the fast food industries? These are labor, who just got, remember, the wage increases, the fast food industry. Do the supplier power there, the food ingredients, commodity prices, do they have a lot of power or not? All right, called a 2. Entry and exit. Is it easy to open up fast food chains? 5 Guys, etc. Is it easy to open up your chain? Does it help the industry? Are there barriers to entry?
Yeah.
So score that one. 4. Helps the industry, but not a whole lot because you can still open up a chain. Okay. Substitutes. Are there choices we have besides going to McDonald's to eat? And are they pretty prevalent?
Yes.
So score the power of substitutes on them. 2. A lot of intense rivalry, which should hurt the industry profitability because I can go to a grocery store and get some prepared meals. People are starting to cook at home again, right? What about rivalry? Is there a lot of rivalry between these players?
Yes.
So score the rivalry. If rivalry is high, lower score. So give me a number. 2. Okay. You're going to get a 0 on your assignment. Because what you just told me doesn't make any sense. This story does not support that this industry makes a 33% ROIC. Think about it. They're making an observable ROIC. And don't get me wrong, I did this for this exact reason because I had an MBA student, I was teaching an MBA version of this class, and they had the exact same problem. They couldn't get past their own bias that there was no way that McDonald's and this industry could be making as much money as they could because they went through the exact same rationale that you did, and they said, I can't explain it. But that's what I'm saying. We have to explain it because that's the data. They're earning right now, well, that would be more like the energy industry. If I go here, all of these players are making pretty good with the exception of Wendy's. All of these players are doing really well. So something about our bias is wrong. So this is what I mean by we have to do a realistic assessment of the 5 forces. It explains what we see. So where are they making money? What force or forces do you think we're actually wrong on? Yeah.
Substitutes, I think they're actually positioned pretty well. They're like a cheap alternative to restaurants. So
Okay.
people would be more willing to substitute them.
But at some point, I got to call at least one of these a 5.
Yeah.
So maybe it's substitutes. I'll also tell you that I think the entry and exit barriers to becoming a national chain are also extremely high because there's not that many national fast food chains. And having even a 5 Guys become national as opposed to regional is very, very difficult. I'll also say, because I asked the last class this, I'll ask you the same thing. How many of you eat out for fast food more than 5 times a month? Just by show of hands. It's okay to admit it. Okay. So how many of you go to 5 different places? More than 5 places a month to get your fast food? What I'd be willing to bet is most of you go, with one exception there, most of you tend to go to the same places pretty often, right? And so that's the point. There's a power of the brand, right? And I think building that brand has, despite McDonald's and the poor quality of the food, people still go there on US 1 because it's just you're used to going there for better or for worse. And so I think that the buyer power is a lot less. It's not that we don't have it, we don't exercise it, right? For whatever reason. And I think that's what's allowing the industry to do well. And right now, that's allowing the industry to do well because think about rivalry. How are they competing? They're not competing on price. They're competing on what? What's the real rivalry? Menu, choice. Nobody wants to lower the price to $99 burgers because they lower their price to 99-cent burgers, sorry, $99 burgers, 99-cent burgers because they all lose. So there's a lot of rivalry, but they're not fighting to the death on who has the lowest price. In fact, last time I went to Chipotle, you can't get out of there for less than $8. I mean, that's the point. They've all been competing on other features which have allowed them to make more money because it's not a price competition. Now, I'm not saying that can't change, but that's what we would have to understand is do we think this could change in the next 5 years as we think about healthier lifestyles and how it starts to choose whether substitutes become more attractive and whether certain chains then say, I have to compete on price because I can't compete on value as other people have done. That could be a different story. So final piece is to help you with this. On Canvas, the last link in Elms, which is frozen here on my screen, but the last link in Elms is to go to, it's called VBIC. And when you go to VBIC, you can go to IBIS World. You guys used IBIS World before? IBIS World is industry research. It's under the, unfortunately, my browser has frozen. So VBIC homepage. It's under industry. IBIS World is the first link. Go to IBIS World. This is where you can get industry research reports. So you can type in a company or an industry. So in this case, I'll type in McDonald's. And it'll show you the industry reports for McDonald's. And here's fast food restaurants in the US. And industry performance, industry outlook, they've already done a 5 forces analysis. So because we're dealing with the real world, it is perfectly acceptable in this class to use real world data to help you answer these questions. So if I said, what's the fast food industry going to look like in 5 years? Using some of this type of industry data to help you answer that question is acceptable with the following exception. I don't want you to plagiarize. So you must reference if you use real world data. But as long as you're referencing, that's perfectly acceptable to help you with the answers to the class. Because you're going to have companies this semester you'll know nothing about, right? And that's okay. And relying on data sources to help you learn about the future is perfectly fine. Because if you had to make it up, that's what you're going to be doing. You're going to be making it up, right? So in your homework assignment, which will be homework 3 for next Monday, like I said, you're going to have to do some of these tools using some of the custom fields that we've described today that Stas is going to show you on Wednesday how to do. And I'll post the homework at the end of day Wednesday. It'll be due next Monday. But we're going to practice doing this industry analysis as our next homework assignment and putting in our crystal balls to figure out whether or not we think that the industry is going to be good. Okay? See everybody on Wednesday. And this will be posted on YouTube.
I had a question for you.
Let me save this before I lose it. So this is
I don't know if you remember
September.
or not, but I was on, we lived together. On the right floor. Well, 3 years ago now, I guess.